and admitting people, and then I'm going to move myself out.
Mhm. Hello, everybody. It's 11:30, so we're going to go ahead and get started while people are still logging in and getting ready. We will wait a little bit, but I'm going to cover some housekeeping items right now. This recording meeting is being recorded and will be made available and sent. A link will be sent to the email addresses that you used in your registration. In addition, it will be available online at our website at kbgrp.com. We did solicit questions from you as registration in your registration, and we will be doing our best to cover all of those today for you. We want to remind you that you have been muted, and we would ask that you continue to have your microphones muted during the entire presentation. We do have a number of people still coming in, so I will hold until I see our total count be a little higher. They're being allowed in. Okay, we'll go ahead and get started. We want to thank you for joining us today with for our webinar, What Changes May Be Coming with the New to Taxes with our new administration. I'll do an introduction to those of us who will be talking. My name is Beth Ebersole. I'm a tax partner with Kirkering Barberio. And with us today who will be speaking on the various subjects are Kathy Hargraves. Kathy heads our healthcare department, and as such, she does a lot of work with the professional service organization and with wage earners that will be affected today. Also, Michael Goldstein. Michael heads our Lakewood Ranch office and does extensive work with our larger businesses and handles a lot of real estate transactions. Brian Lydell. Brian heads our Tampa office and works with many businesses and many individuals and handles a lot of our attorney practices. Heather Williams. Heather heads our estate and trust department and is instrumental in helping our clients deal with their estate and trust issues and compliance. As I indicated, we did ask for questions when you registered, and we will be covering those today. However, I did want to just point out to you that when we're talking today about the taxes, these are not proposed taxes. These are just potential of what is out there and what we have heard from the new administration that came in on their campaign trails, whether it was the debates or their website, but things that they have talked about. There is nothing out there in Congress right now. However, we do want to think about it because with the election of the 2 Democratic senators in Georgia that happened earlier this month, it is officially looked at as if there was a 50-50 split in the Senate. And when there's that, we have the vice president who is the tiebreaker. And that would make the Senate be potentially Democratic. And the House already has a majority of Democrats. So there is the possibility that these laws could get passed under what's called a budget reconciliation process that allows just a simple majority as opposed to the way a normal law goes through. That is how the Tax Cuts and Jobs Act went through back in 2018. But in listening to some of the experts that have their ear closer to Washington, a lot of the talk that's out there is that these tax cuts or these tax increases will not be going through necessarily in 2021 due to the struggling economy caused by COVID. So the only one that they're talking about potentially is the corporate tax rate, but everything can change, and certainly it can change again in 4 years. So, but let's get to the questions that you guys did have. Let's start with one that we heard a lot. Brian, can you help us and cover the proposed changes to the ordinary and capital gains rates that we heard talked about?
Sure. Good morning, all. The expected Biden tax plan, again, this is not a proposed plan yet, just an expectation, it calls for a restoration of the top tax rate to 39.6%, up from the current 37%. For 2021, this tax bracket begins at $628,300 for joint filers, $523,600 for a single filer. There has not been discussion as far as changing these brackets, the thresholds. Now, the big change, of course, everyone's heard of is expected would be an increase in the tax rate on capital gains and qualified dividends up to the top ordinary rate for those with taxable income in excess of 1 million. Now, this is a substantial increase from a current top rate of 20% up to 39.6. And don't forget to add the 3.8% net investment income tax to that number. So we're looking at a 43.4% rate on investment income over when your taxable income's over 1 million. Now, the expectation is that this calculation will be similar to how the net investment income tax is calculated, where the amount subject to that higher rate is the lesser of your long-term capital gains and qualified dividends or the excess of your income over 1 million. So meaning that if your income is $1,001,001, it doesn't trigger the top rate on all of your investment income, only on that one excess dollar. So again, I think Michael will have an example for this later on. And again, I'll turn it back to Beth.
Thanks, Brian. Michael, that is actually a question that came across. How are the changes that Brian just talked about, the capital gains, et cetera, going to affect some of our real estate investors?
Thank you, Beth. Well, good morning, everybody. Just like Brian just explained, the ordinary rates obviously will affect anybody with income in the highest tax bracket. So whether your income is coming from wages or investment or real estate, if you're subject to a highest marginal tax rate, 39.6% will kick in. What is probably more important is for the real estate investors is that capital gain tax. Whereas the sale of real property, when you're using it, say rental property, is not really considered to be capital gain, but it's taxed as a capital gain. And so we all know that in those instances, when you actually go ahead and sell a property, you can generate fairly significant gain on that real estate because it's been depreciated. And so now if your income is over $1 million, some of the gain might be taxed at much higher tax rate. And a little bit later, I'll try to show you what it possibly means. There is another proposal from Biden that affects not only real estate people, but other business owners who have been enjoying a break that was passed back in 2017 called qualified business income deduction. And some of you might have experienced it, some of you might have heard about it. It's if you own a business, which real estate is considered one of them, and it's a qualified business, it's not a service business, you get a tax deduction of 20% of that income from your taxable income. And so Biden proposal would reduce the people who get benefit of that to anybody whose income is over $400,000. So if your income from all sources, presumably, is over $400,000, you lose that QBI deduction. So those are the three general things. There was a statement that Biden made that he wanted to eliminate unproductive and unequal tax breaks for real estate investors with income over $400,000. And the what most advisors take it to mean that he will propose elimination what's called of a like-kind exchange ability for the real estate. People who own real estate probably aware is that under the current law, you have ability to sell your real estate and reinvest the proceeds into equal or more valuable piece of real estate and not pay taxes on the property that you sold. It's called the like-kind exchange or 1031 exchange. Well, what Biden proposal supposedly will do is would eliminate that ability to do those exchanges and deferring the gain for people with income over $400,000. Logistically speaking, I'm not sure how that would work. I mean, how do you measure the $400,000 when? In the sense that the exchange can happen early in the year and you might not even know what your income is. So is it based on the prior year? Is it based on some kind of an average? We don't know. But that's one of the possibilities that has been floated. Another possibility was floated is that he might, Biden, eliminate some of the accelerated depreciation that some of the property in the real estate trade or business is currently eligible for. Some of the property you might be able to take 15-year life and expense it sooner, whether instead of much longer life. And one of his proposals theoretically could eliminate that tax break if you own the real estate. And I'll try to demonstrate some of it a little bit in an example later. Back to you.
Thanks, Michael. I was going to ask you about that 1031 if you didn't add that. We also have a lot of professional service organizations, healthcare on the line. Kathy, how's this going to impact them?
Yeah, interesting. You've heard from, I heard from two people now. Biden loves that $400,000 demarcation, doesn't he? We have a lot of professional service organizations that we do the tax and consulting services for. I happen to be part of the healthcare team. And so, of course, we're just doing professional service organizations. And as part of that, we're looking at the tax effects on both the business and the individual in a holistic way, if we can. Well, that's what we try to do. So most of our clients actually own their own businesses, and as such, they act as both the employer and the employee, of course. So really, one of the most impactful statements and not proposals, but thoughts that Biden's actually had has been in not the income tax area, but he's proposing an additional payroll tax, which would affect, guess what? Individuals over, you got it, $400,000, right? The way it stands now, everybody pays FICA, Medicare taxes up to this, what we call it the FICA cap. And the FICA cap for 2021 is going to be $142,800. They keep raising that in the last few years a lot. But what's always been good news is that it consists of our payroll taxes are comprised of two different pieces, Medicare and Social Security. And at this wage cap, the Social Security piece of it dropped off. That accounts for 6.2% of your wages. And the employer has to also match that. So everybody gets a benefit if they can hit $142,800 for the rest of their wages, in that they don't have to pay that tax. Well, now what Biden is talking about is initiating that again at the $400,000 level. So from 0 to $142,800, individuals pay 7.65%, and that's matched by their employer. A lot of times it's the same person, right? So it's like over 15%. And now he's talking about instituting that again at over 400,000. So instead of that dropping off, individuals are going to have to pick up another, really it's 12.4%. They've always had to pay the Medicare tax throughout, the whole W-2 wages. So that's actually a lot of money if you happen to be one of those high earners. So if a physician, one of my clients, made $500,000, he or she's going to pay an extra $6,200, and their employer, normally them, is also going to pay the same amount. And I might add, they are also paying an additional Medicare tax on amounts over 200 or 250 if they're married filing joint. So that's actually a big deal. Of course, they're also going to pay an extra that extra income tax if they happen to be lucky enough to be in that top bracket. And you know, Biden uses the 400,000 again very loosely, saying that's when we start that new bracket. And the other thing that I think is actually going to affect a lot of our clients is his stance on independent contractors. You may have read or heard about the buzz he's making with independent contractor status, in really saying that the laws are too loose. We have this gig economy, which is exploding because of COVID, and so many people are independent contractors. They choose to be independent because it fits their lifestyle, and it does allow us as consultants to help them to maximize their benefits and to apply benefits on an individual basis. So it's a lot easier to plan in the retirement arena, especially if you just have one person to worry about and no one else. So they like that status. What Biden is talking about, and I don't know how serious he is, he's talking about looking at the California model for independent contractors. And if you've read about that or followed that at all, it's kind of a hot mess out there. Very few, it's very confusing. Doesn't feel like people can actually fit that mold. So we're going to be keeping our eyes on that independent contractor status. And remember, one of the big benefits they get is this ability for us to design specific individualized retirement plans. And that is another thought that Biden has, is that our retirement planning is benefiting the highly compensated. And it's true, it does. So if you happen to be right now in the 37% bracket, you get a 37% deduction for your retirement plan expense. If you're in the 10% bracket, you only get 10%. He's talking about making that benefit more fair across the board, so that everybody would enjoy the same exact benefit. And he's floating at numbers that we think are somewhere around 26%. So no matter how much you made, you would get a 26% benefit. He would probably do this through a refundable credit. Now, that's going to, of course, upset the apple cart in our planning. I'm not sure in the small business world, we often look at how much the tax savings are, and we use those tax savings to fund the benefit for staff. So if we cut the tax savings for owners, it goes to say that we're going to possibly see some decrease in the benefits that are afforded to staff. So I think that's kind of a big deal. Michael alluded to the phase out of the deduction, again, at 400,000. It's already phasing out for our service professionals, attorneys, consultants, physicians. There are certain named businesses. So that's, I mean, it's a big deal, but it's not quite a big a deal as it would be for someone in manufacturing or a different industry. So those are kind of my top picks, Beth. of things to watch out for. And, you know, we're certainly keeping our eye on the other topics, but those are the things that I think I'm gonna, you know, let my clients know about.
And I was just thinking as you talked about the compensation, you know, the first thing that people are going to think about, okay, I don't want my compensation to be $400,000, but we are still dealing with the requirement of the IRS that your quote unquote salary is reasonable, and the thoughts that have been floating out for several years, Michael, you might need to help me on this one, that every dollar coming out of an S corp will be taxed like a partnership and subject to self-employment rather than how it is now. So
Yeah.
that's out there too, that we have to keep watching, and we're not sure how this is all going to interplay.
You're right. We always make sure we have reasonable compensation studies.
Exactly.
Yeah.
So there's a lot out there, but we haven't covered one big area that I know a lot of you guys are interested in. Heather, can you give us some thoughts on what you have heard about potential thoughts that Biden has on the estate and trust levels and tax rates, et cetera?
All right. Good morning, everyone. So from the TCJA that was passed at the end of 2017, as you guys know, they kind of like to pass a lot of laws right here at the end of every year. They doubled the basic exclusion amount from 5 million to 10 million. And that was for just a short period of time, from 2018 through the end of 2025. Today, the state gift tax exclusion for 2020 is 11.58 million, or 23 million per married couple. The GST mirrors at 11.58 million. So what that means is a taxpayer can transfer property by gift or at death up to this exclusion amount before they're going to pay any estate or gift taxes. So what Biden's proposals is, he'd like to accelerate and reinstate the pre-2018 exclusion amount, which if we adjusted that for inflation, it would be about 5.5 million or 10.5 million per couple. Biden's rules, his proposals, they have not touched portability, which allows the predeceasing spouse to pass their exemption amount over to the surviving spouse. So this is known as portability. But let me just remind you that you do have to file a Form 706 tax return to claim this. Currently today, the maximum federal gift tax rate and the GST rate is 40%. In his proposals, he has not increased the tax rate. However, you know, we would all be very surprised if the Democratic Congress did not seek to increase that tax rate and obviously further reduce that exclusion rate. You know, we've heard lots of numbers flying around, 1 million, 3 million, 5 million. So it's a wait and see. Beth, back to you.
Okay. Michael, you alluded to having an example for us. And for those of us that are visual learners, that might be helpful. Again, I'm going to caveat, this is what we are thinking we hear now. Everything's subject to change. But Michael, I think you've got some an example to show us. And then that will handle the real estate side. And then there's one right after that that Kathy will cover on the high earner.
Right. And before I share it, I want to just repeat what Beth said. This is not a tax calculation under the Biden proposed tax plan. There is no plan. Nothing has been proposed. All we hear right now is campaign speeches and some policy ideas. This was really just my own exercise. I was trying to kind of visualize, like Beth said, some of us are visual learners. And so we throw a lot of numbers at you and kind of stuff. And how does it actually might affect somebody in a real life situation? So this is just my interpretation, because with the tax law, you know, the ideas are really easy to say on a stamp speak, but how is it actually going to work? We don't know. Simple example of $400,000, we still don't know if it applies to individual or is it to a married couple. You know, is it a per household? And does it mean that it's a $200,000 for individual and $400,000 for a couple? We just don't know. I mean, he keeps talking about $400,000 per earner, but we don't know the details. So with that said, I will share my screen and we'll kind of briefly go through this. Okay, so for my example, I'm assuming that this is a married couple, that they have investment income of $100,000. They have a rental property that produces net rental income of 150. They have a rental property that they purchased years ago and they paid 700,000 for it. And they have been depreciating because it's a rental real estate, and accumulated depreciation at the end of this year is $250,000. And they're selling that commercial real estate in this year, and the gain, the sales price of the property is $1.5 million. And for the simplicity, I assume that the couple taking a standard deduction, because with all the phase-ins and phase-outs and limitations of buying proposal, this would be too much to even attempt to estimate. So the current rules indicate what the tax would be for 2020 under the current rules. So as you see, they have an investment income of 100, 150 rental. The capital, the gain on the sale of the property is $1.5 million, right? Your basis is 700 minus 250, and that's $450,000. You sold it for $1.5 million, so your net gain is $1.05 million. So the total gross income is $1.3 million. You get your standard deduction, and then you get what we call disqualified business income deduction, right? It's because rental real estate qualifies as one of those favorable trades or businesses, you're allowed to take that rental income and compute a deduction theoretically at 20% to reduce your income. Now, some of you might notice that 17.5 is not 20% of 150. That would be $30,000. Well, that's because there are currently already limitations in place for people with incomes over $400,000 for 15, I think, that provide additional ceiling on how much you can claim as a qualified business deduction. And in this case, it would be 2.5% of your original cost of the property. So $700,000, 2.5% is 17.5. So we come up with the taxable income of $1,257,000. And when we compute the tax, you get your what I consider ordinary and capital gain tax of $245,000. And it's way too complicated to try to explain it in 1 hour how it accomplishes, but that's what the tax would be, because you get a benefit of the lower tax breaks, and then you get a capital gain tax rate. Because your income is significant, there is some alternative minimum tax. And then the 39.9 is that investment piece that Brian talked about. It's what commonly known is Obamacare, remember, for the payment for the Medicare. That's the 3.8% surtax on all of your investment income that applies to the passive income, the rental, and capital gains, and dividend income. So your total tax comes out to be just under $295,000. So what might it look on the Biden proposal? So our gross income is the same. I'm assuming the standard deduction will be the same. That remains to be seen. One thing that will drop off, because this income is more than $400,000, whether individual or a couple, you would lose that qualified business deduction. So that's 17.5. So that's relatively not a big deal. Because you have higher total taxable income, right? It's $17,000 more. Your ordinary gain and capital gain tax will be higher for that difference. And I need to explain that for my calculation, I use the same rules as in effect right now. So the marginal rates and the tax rates that are currently in force, that's how we compute the $250,000 and $10,000 tax. And that, again, we don't know, because if you think about it, right now, the highest marginal rate does not apply to the individuals if their income is less than $518,000. I don't know how, or for a couple, it's $622,000. Well, it's clearly more than 400. So will that affect, will that be changed under the Biden proposal when he wants to increase taxes for people making 400? We just don't know. But the big piece comes in is obviously the investment income doesn't change, it stays the same at $39,000. The big piece comes in is this proposed gain, because your taxable income is higher than $1 million, right? So you have $275,000 that is in excess of $1 million. And like Brian explained before, we think or we hope that the excess tax will apply only to the difference between what your actual income is against $1 million. So in this case, it would be $275,000. Now, remember, my calculation already accounts for all the lower tax brackets on that income. So the $40,000 additional income is not 39%. It's really the difference between 39.6% and the 25% that some of the real estate gain is subject to. You know, some of you might know that depreciation deduction that you claim as ordinary deduction, when you have to sort of pick it up as income, gets taxed at maximum rate of 25%. So the difference between 39.6 and 25 is what that $40,000 represents. So you can see that additional tax on the theoretical proposal would be higher by about $46,000 or about 16%. And the 16% is logical in the sense that we have slightly higher overall taxable income because loss of the QDI deduction and because of additional 15% tax, 14.96% tax on the capital gain. So that's what it might look like. That's like I said, a lot of ifs and buts, and it's not something that you can rely on. It's just kind of a theoretical exercise just to see how much would it cost theoretically if this set of circumstances was met. Back to you, Ben.
Yeah, great. That's great. Like I said, I'm a visual learner, so that helps me a lot. But again, this is pure assumption that we are making. Kathy, what was your example for the high earner?
So I just wanted to show folks the differences. Michael did such a great job. I just wanted to show some of this really shock value. If you happen to be over that 400,000, what it's going to cost you. So I talked about the payroll taxes. If you happen to be, making up 500,000, just the differential in that 100,000 in terms of dollars, and then contrast that even to the difference in paying that extra income tax. The payroll taxes are more. The retirement plan contribution deduction that you wouldn't get anymore, that would factor into certainly decisions and strategy. And then lastly, if you're just fed up with everything and you decide to sell your business and buildings and everything and retire to Florida, there's a big shock in terms of that extra income tax that you're going to have to pay on the sale of your property. So, it's going to be very impactful in a couple of different ways.
Potentially, we just do not know. But yes, some of these numbers can get big. Do want to remind you though also that some of the tax savings we are enjoying right now are set to sunset in 2025. Of course, maybe a lot of people thought that they would be extended depending on the administration, but that is how a budget reconciliation act gets through. It's reconciled to a good budget.
Yeah, Beth, I think all we can say, it was nice while it lasted, right?
The way we look at it. But there were a few things that were to people's positive rather than all negative. I don't know that it'll affect a number of people on our call here today or our webinar here today, but it might affect your children or grandchildren. So Brian, you want to cover a couple of things that actually were going to be helpful to some people on the individual level?
Sure. Well, again, much talk about the stimulus payments, and the expectation is that an additional $1,400 would be sent for those who qualify, which when added to the $600 that was sent late December, early January, would get them to that $2,000 number that was floated by Democrats, leading up to the bill that President Trump signed on the 27th. Now, on the 2020 tax returns, there's going to be a reconciliation of the stimulus amounts that were received in both rounds. So if there's any shortfall, that additional stimulus would be added to your refund or reduce your tax. Now, if there's an excess amount that someone received, they will not be required to pay that back. And again, part of that's part of the reason the IRS is configuring their computers. They've indicated that they're delaying filing season until February 12th. Part of that is so that they can account for this reconciliation of the stimulus payments. There's also a couple changes that Biden has talked about that he would possibly propose to a couple credits. One being the child tax credit, which is currently up to $2,000 per child. This would be raised to $3,000 per child, and actually to $3,600 for children under 6 years old. The credit would be fully refundable, meaning that if someone had zero tax liability, they would still get this credit as part of their refund. Also, the child care tax credit, which is currently limited, it's just between 20 and 35% of eligible cost, and the costs are limited to $3,000 per child or $6,000 if you have 2 or more children. Those limits would be raised to $8,000 of cost per child and $16,000 if you have 2 or more, and the credit would be increased to a potential 50% of that. So up to an $8,000 credit for 2 children if you do qualify for that credit. Again, different phase outs have been proposed. Not surprising, the $400,000 number seems to be where that phase out would be fully, those over 400,000 would not get some of these credits. Again, there's also a plan to create a new credit up to $5,000 for helping those who are taking care of other members, either members of their family, such as elderly, disabled, or veterans with service-related injuries. So this would be a new credit in the regime. Also, this is interesting. Biden has talked about reinstating the first-time homebuyer credit. This was actually implemented back in 2009 and 10 during the recession. It was a credit that was available for first-time home buyers to offset their closing costs, and it was done when they filed their tax return, either in the year that they purchased the home or the year after. Well, this is proposed or talked about as being a permanent credit, refundable, and even better, advanceable. So advanceable meaning that when you buy a new home as a first-time home buyer, you could fill out a form and the IRS would send you a $15,000 payment at the time of the purchase. You wouldn't have to wait until you filed your next year's tax return. Again, we're expecting these credits to be phased out somewhere between 150 and 400,000 of income. So this may not impact many of you, but your kids and grandkids may be able to take advantage of this. One other credit that's out there, and they don't have the exact details yet, but a credit for renters, low-income renters, so that their total rental cost and utilities is capped at 30% of their income. Again, this is just something that at this point they don't even know the dollar amount of the impact this would have on the economy. So I think a lot more research would need to be done before this gets something like this would be implemented. And Beth, I'll turn it back over to you.
Okay, so that was a little bit of good news for some individuals, maybe not on this webinar, but maybe just somebody they know. Michael, there's a couple of things that we thought we were seeing on the business side. Do you want to try to see if you can tell us what you're hearing on that so our webinar group knows?
Sure. One of the proposals on the Biden's proposals was to increase the corporate income tax. As Beth alluded to before, the Tax Act of 2017 had a couple of different components. And some of those components were permanent, and some of those were temporary. Like everything on the individual side, qualified business income deduction, reduction in the estate tax, were temporary. But reduction in a corporate income tax, and this applies to what we call regular C corporation. These are the corporations that are not a pass-through entity that pays its own tax and was reduced from what used to be 35% to 21%. Well, Biden been talking about raising that permanently reduced tax from 21 to 28%. And this is one of those actually proposals that most commentators feel has a very good chance of passing, possibly even this year, because you might recall that even back in 2017, when the Tax Act was passed, there were a lot of even Republican officials that wanted a higher tax rate. Some wanted lower, some wanted higher. So the feeling is that this might actually happen, and it actually might be retroactive and might happen this year. Another proposal that Biden was floating would affect really large corporations, those with income over $100 million. And what he's proposing, as part of the 2017 Tax Act, there was an elimination for the corporation, was elimination of alternative minimum tax. That was the whole parallel tax system where try to tax some companies that, because of the different tax rules, would, even with the incomes, don't have to pay any income tax. So Biden is proposing to bring that back, but only for a very large company. That's again, that would be minimum tax of 15% on incomes over $100 million on their financial statements. One other, I guess, negative proposal he's proposing, and that just
Positive, Michael.
we'll cover the positive too, is he is proposing to put a 10% offshoring tax penalty on the businesses. And what that is intended to do is surtax the income that if you're a business and you are moving production or service overseas to be sold back into the United States, that portion of the income would be subject to 10% additional tax penalty, which will bring your income tax on that portion to potentially 38%. To encourage businesses, especially the manufacturing businesses, to bring back the jobs into the United States, he also proposing what's called Made in America tax credit of 10%. And that will kind of work the opposite of this offshoring tax penalty. If you actually bring back the manufacturing jobs or open the plant that was closed or keep it going or increase the wages for the manufacturing employees, you get a 10% tax credit. Again, details at this point are very sketchy, and that's a general statement, but as you can see, he's continuing with that thought that we want to bring some of that manufacturing, some of the production, especially the stuff that is being sold in the United States, back to the United States. Obviously, if you're a business and you're moving your production to Mexico to sell in Mexico, there will be no penalty. But if you're moving it to Mexico to turn around and bring it back and sell it in the United States, that portion of the profit, he wants to tax additional 10%. Also, they've been talking about, the climate change is real, and they want to encourage people to invest in green technology. So there are certain credits that were talked about making permanent and extending, like a solar investment tax credit on investment in the solar equipment. He's talking about increased incentives for the energy efficient technologies We don't quite know what that is, but again, it goes with the theme that we want to encourage businesses to use more green technologies. And he also mentioned something about establishing a manufacturing communities tax credit for 5 years. That's kind of a general statement. We don't know exactly what it is, but again, it goes with the theme that we want to bring some of the manufacturing or expand some of the manufacturing back in the United States. So not all bad news, but devil is in details. So we yet to see what is happening. And just to say that, once 28% does not mean it's going to go 28%. And a point that this tax cut for the corporation to 21% was permanent. But because it's highly unlikely that he will get 60 votes in a Senate for any tax increase, it most likely will go under the Budget Reconciliation Act, which, as we all know, the tax policy can change with every administration. That's the route they go. Nothing is permanent. Back to you, Beth.
Okay, so that covered a lot with our business people. Let's finish up our session because I know a lot of our questions came in regarding the estate taxes, and with the information that Heather's already given us, is there what else is out there and what could possibly what should be people be thinking about? So Heather, I'm going to turn it back over to you.
Obviously, none of us can forecast what tax laws are going to be changed. But when you're thinking from the estate side, right now is a good time to consider shifting assets out of an estate because the laws are currently favorable. But the real question you have to ask the client or ask, the taxpayer is, if can you maintain your lifestyle if you no longer have access to these assets? So some of us planners on the call all remember back in 2012 when we thought that we were losing the estate exemption, that many people ran out and gifted. And I think there's been a lot of buyer's remorse. So, the hindsight is we probably wouldn't have done that. So the other items right now you can kind of consider is, you can still consider gifts to your family, but don't forget about the basics, the annual exclusion, the $15,000 per person, $30,000 per couple. There's also the 5-year funding of the 529 plans that you can accelerate that funding. Right now, family loans and other note transaction techniques are really great in this low interest environment. So that's something to consider. Valuation discounts are still available on transfers of closely held businesses. However, the question I think is how long? The previous, under the Obama administration, they did have proposed regulations to restrict and limit the business valuations discounts. So I think that, now is the time to look at that and consider. It is probably a use it or lose it type time that we're in regards to the gift and estate tax exemption. The IRS did at the end of 19 provide favorable clawback regulations. So what this is it gives taxpayers credits for any gifts that they make under the current laws. So a lot of high net worth clients are probably going to be considering additional planning in 2021. And they're considering this now because they want to use the remaining amounts of their exemption before potential reduction. However, not to put any sense of urgency on that, proceed with caution. There is some remote possibility that we may see changes retroactive back to 1/1/21. But I think we can really just sit and see what happens over the next couple months and therefore have time to considerate, the entire year to considerate different gifts. We may see changes next year that go effective in 2022, or we may just see no estate law changes and be waiting for that sunset on 12/31/2025. So that's kind of a high level in the area of kind of what client planning we should consider. A couple other things I wanted to note. Again, these are just proposals and talks, and Biden obviously it's not very clear on really what he's thinking. He has, it's unclear whether he wants to eliminate the step up in tax basis or impose an income tax at death. So these are just two items floating around. So really, what does that mean? right now, under the current law, the cost basis of property transferred at death receives a step up in basis to its fair market value. So what this does is it eliminates the heir's capital tax liability on the appreciation of that property during their life, during the decedent's life. Now, if you choose to give property before you die, the person that's receiving it receives carryover basis. And what this means is it's the donor's original cost. It's just carried over to the recipient. And so when the recipient sells that asset, they will pay capital gains tax on the appreciation. So the step up in basis rule that we currently have, really it discourages people from realizing capital gains. So if Biden's policies were to eliminate this, obviously this would be a huge increase to federal tax revenue. So the other issue with the step up in basis rule is it really reduces the compliance cost burden on the heirs. So it's pretty hard in some cases to figure out what the basis is of a long-term held asset. It's very difficult. And again, Congress, or this approach was actually tried in 1976. And the implementation of eliminating the step up in basis was so complex that they repealed the tax law before it ever went into action. So it'll be interesting now with the environment we are in, what happens. But eliminating this policy without changing the current estate tax laws would definitely put a huge tax burden on the heirs. And it would obviously increase the compliance burden for taxpayers to figure out the basis. One other proposal is death as a realization event, and we see this in some other countries. But under the current law, a death, it's not a taxable event when you die. But Biden would treat this as a realization event. And what this would mean would be the decedent would be treated as if they sold all their assets at fair market value on death, and they would be taxed on all of the unrealized appreciation. And they would pay this tax based on the long-term capital gains rates. So kind of as Brian talked about, if you're over that $1 million mark and you had to suddenly, all of your assets were deemed sold, you could be looking at, everything excess of the million at the 39.6%. So that is just another one of Biden's proposals that's out there. It's very unclear if either of those will gain ground. It might just be easier for them to kind of look at reducing that basic exclusion. So Beth, back to you.
Okay, I think we have covered most all of the questions that came in. I think there were a couple in chat that we will be answering offline with all of you. So I just want to thank all of the panelists for getting up to date. It's always a catch-22 for us. How much do we learn about what is proposed when nobody really knows what's going to happen? And there is a lot of tax law that actually has passed that we need to know too, and that we're working on to be ready for your tax season this coming year. But so I will use that as our closing. And again, I want to thank the panelists, and I want to thank all of you for being online here, for joining us. Again, we all said this is proposed, we're trying to learn it. So we want to let you know that obviously we're trying to keep up to date with this and watching all of the things that are happening, and we will keep you up to date either via some email blasts or social media posts. We will do more webinars like this. So we do want to keep everyone informed on what's going on. I will let you know that we do put out a bi-weekly newsletter, and if you would like to get that and you don't get it now, that can be signed up for on our website at kbgrp.com. Again, we will be emailing to each of you a link to this recorded session with the email address that you provided on your registration. And again, thank you for joining us, and we do appreciate you being with us and us being able to share with you. Thank you.
Thank you, everyone.
Thanks.
Thank you.
Thank you.